this week's episode, I wanted to bring up a loan that's been around for a little bit, and some of you may or may not have heard of it. It's conventional financing, but it's through Freddie Mac.
Okay.
And it's called the Home Possible. And for many, many years, FHA was the most favorable loan if you were going to live in a property to buy a multifamily without having to put a big down payment down.
3.5% down.
Yeah, 3.5%
FHA, Federal Housing Administration.
So as long as the borrower, the customer, was going to live into the house, then they could use the FHA, and you could buy up to 3 or 4 units. 4 units. Freddie Mac just recently came out with this loan. It's called the Home Possible, and it's very, very comparable to the FHA loan.
Okay.
And it's really good for. There's some awesome incentives for first-time home buyers, but it's really focuses on low to moderate income borrowers. And,
okay.
And the way that you can tell if you fit in that category or not, it's not to say like you don't make any money or anything like that. It's every county has a AMI. It's the average median income for the household. As long as the borrowers don't make above that AMI, they qualify for be able to use this loan.
What's the down payment? What do you have to put down? Is it
so
3%?
on a multifamily, there's 3% scenarios.
Okay.
But also it shoots typically 3 to 5% is the low down payment.
And that's not bad to get in a home for 3 to 5%. Now, what are the other incentives for first-time home buyers? Well,
there's lower MI, and there's really good interest rates for them that also compare to FHA.
Mortgage insurance?
Mortgage insurance, yep. Normally it's just about 30% in coverage.
Yep.
When we put in for the Home Possible loan, it's 25%, so there's a significant reduction, which really helps with the payment. My favorite part about it is that if you typically, people that are interested in buying multifamily and building their financial portfolio that way,
yes,
which is something I really, really, really have a huge interest in, that they still have their FHA eligibility intact.
Oh, nice.
So if you buy your first one with a conventional Home Possible, and after a couple of years after you're living there, and if you want to expand on that category in that section, you can go do another mortgage FHA with just 3.5% down. So now you can get into 2 multifamily situations without having to, put these significantly huge down payments down. But you just have to do it right.
One thing that I always tell my clients, especially the ones that are investor savvy, the ones that are really looking to purchase that first time home or second time home, and they're looking to buy a multifamily or something, what I tell them is, listen, you're better off going conventional, because that mortgage insurance, you can't get rid of it on FHA. It's through the life of the loan. When you're conventional, and correct me if I'm wrong, Matt, but when you're conventional, after you have a 20% equity position in that home, you can contact the bank, ask for a broker price opinion on the bank. They send it out. It's like $150, $200 you pay them. And as long as you have that position, and then they can drop it, saves them $150, $200 a month.
Yeah, it's huge. But the thing is, for a long time, if you were buying a multifamily, which is the reason why the Home Possible is so popular, because of the multifamily options that it has. Okay. For a long time before this was an option for customers, they had to put 25% down, so there's no option to have an MI on those loans. Yep. Now we're willing to put the mortgage insurance on the loan and do it at a low down payment option. But yes, once you're at that position now, the mortgage insurance would go away without having to refinance.